Have you ever felt like you're working harder than ever but your bank account just isn't growing? You're saving, you're being careful, but somehow you feel stuck in the same financial spot. What if I told you the system is almost designed that way? The silent thief known as inflation is constantly eating away at the value of your hard-earned cash. Leaving your money in a standard savings account is like trying to fill a bucket with a hole in it. You pour money in, but inflation ensures it's always leaking out, year after year. This is the fundamental difference between simply saving and actively building wealth. The majority of people let their money sleep, hoping it will be there when they need it. But the wealthy understand a crucial secret. Money must be put to work. It needs to be an employee that never sleeps, never takes a vacation, and is constantly generating more for you. They don't just earn money, they deploy it strategically. Today, we're pulling back the curtain on this exact strategy. We're not just going to skim the surface, we're going to deep dive into the best investments for 2025 and beyond. These are the asset classes that have consistently proven their ability to build lasting generational wealth, and they are more accessible to you than you might think. But before we unlock these financial blueprints, do yourself a favor and hit that subscribe button and ring the notification bell. You're not just subscribing to a channel, you're joining a community of forward thinkers dedicated to mastering their financial destiny. Don't miss out on the weekly insights that could redefine your future. First up, let's talk about the single greatest wealth-building machine in modern history, the stock market. Now, I know what you might be thinking: Wall Street, risky bets, complicated charts, but we're going to ignore 99% of that noise. Our focus is on the smartest, most straightforward way for the average person to invest: ETFs and index funds. Think of it this way. Trying to pick the next big stock like the next Amazon or Tesla is like trying to find a needle in a haystack. It's incredibly difficult and risky. If you bet all your money on one company and it fails, you lose everything. An index fund, on the other hand, doesn't try to find the needle. It just buys the entire haystack. For example, an S&P 500 index fund holds stock in the 500 largest companies in the US. You're not betting on one company, you're betting on the American economy as a whole. An ETF, or exchange-traded fund, is simply a type of fund that you can buy and sell on the stock market throughout the day, just like a single stock. Many ETFs are index funds. The beauty here is twofold. First, instant diversification. With one purchase, you own a tiny piece of hundreds or even thousands of companies. If a few have a bad year, it's cushioned by the success of the others. This dramatically lowers your risk. Second, it's incredibly low cost. Actively managed funds have highly paid managers trying to beat the market, and they pass those high fees on to you. Index funds simply track the market, so their fees, known as expense ratios, are incredibly low. Over decades, those small fees can save you tens or even hundreds of thousands of dollars. For 2025, funds that track major indices like the S&P 500, for example VOO or IVV, or the total stock market like VTI, remain a cornerstone for any long-term portfolio. Getting started is as simple as opening an account with a reputable brokerage like Vanguard, Fidelity, or Charles Schwab, and making your first purchase. Our second powerhouse investment is real estate. There's a reason you hear the phrase, "Land is the one thing they're not making more of." For centuries, property has been a reliable path to wealth. It offers a powerful combination of benefits. First, there's appreciation. The value of the property itself tends to increase over time. Second, and perhaps more importantly, is cash flow. If you own a rental property, your tenants are paying you every single month, which can cover your mortgage and expenses, leaving you with pure profit. This is passive income in its purest form. Plus, there are significant tax advantages. But let's be realistic. Buying a physical property requires a huge down payment, dealing with maintenance, and the dreaded 2 a.m. calls about a broken toilet. It's not for everyone. So, how can you get all the benefits of real estate without being a landlord? The answer is our number 2 investment: REITs, or real estate investment trusts. A REIT is a company that owns, operates, or finances income-producing real estate. Think massive apartment complexes, sprawling shopping malls, giant warehouses for e-commerce, or even hospitals and data centers. When you buy a share of a REIT on the stock market, you become a fractional owner of this vast portfolio of properties. The REIT collects rent from all its tenants and is legally required to pay out at least 90% of its taxable income to shareholders in the form of dividends. This gives you the cash flow of a landlord without any of the headaches. For 2025, consider looking at REITs in growing sectors. For example, with the continued rise of e-commerce, industrial REITs that own logistics and warehouse centers are in high demand. Similarly, with an aging population, healthcare REITs could see sustained growth. It's the easiest way to become a real estate mogul from your living room. Now let's shift from offense to defense. Not every dollar you have should be chasing high growth. You need a foundation of safety and stability. And that's where our third category comes in: high-yield savings accounts and bonds. Think of this as the bedrock of your financial house. First, the high-yield savings account, or HYSA. This is not your typical brick-and-mortar bank savings account that pays you a measly 0.01% interest. HYSAs, typically offered by online banks, can offer interest rates 10, 20, or even 50 times higher. This is the perfect home for your emergency fund, that crucial safety net of 3 to 6 months of living expenses. It's liquid, meaning you can access it quickly. It's FDIC insured up to $250,000, and it's actually earning you a respectable return instead of just losing value to inflation. Next, we have bonds. A bond is essentially a loan. You lend money to an entity, either a corporation or a government, and they promise to pay you back in full on a specific date, with regular interest payments along the way. Government bonds like U.S. Treasury bonds are considered one of the safest investments on the planet because they're backed by the full faith and credit of the government. Bonds play a critical role in balancing a portfolio. Historically, when the stock market is volatile and goes down, safe haven bonds tend to hold their value or even go up. They provide stability when you need it most and are ideal for short to medium-term goals like saving for a house down payment in the next 5 years, where you can't afford to risk losing your principal. Alright, let's address the elephant in the room. Our fourth investment: cryptocurrency. You've seen the headlines, the stories of people becoming millionaires overnight. The allure of massive, life-changing gains is powerful, but this is a territory where you must tread with extreme caution. At its core, cryptocurrency is powered by blockchain, a decentralized technology that allows for secure transactions without a middleman like a bank. The two titans of this world are Bitcoin and Ethereum. Bitcoin is often referred to as digital gold, a scarce, decentralized asset that some believe is a hedge against inflation and a store of value. Ethereum, on the other hand, is more like a decentralized supercomputer. It allows developers to build applications and smart contracts on its network, powering everything from NFTs to decentralized finance or DeFi. The potential is undeniably huge. However, the keyword here is potential. The crypto market is wildly volatile. It's not uncommon to see prices swing 20% or more in a single day. This is not an investment for the faint of heart. The risks are significant: regulatory crackdowns from governments, security vulnerabilities like hacks and scams, and the simple fact that many of these digital assets have no underlying cash flow or tangible value. So, how should a smart investor approach this? With a very clear rule: only invest an amount of money you would be completely okay with losing. For most people, this means allocating a very small portion of their overall portfolio, typically between 1% and 5%. Think of it as a lottery ticket with better odds. If it goes to zero, your financial plan is still intact. If it performs well, it provides a nice boost to your portfolio. Never ever go all in on crypto. It is a high-risk, high-reward speculation, not a foundational investment. We've covered stocks, real estate, bonds, and crypto. But our fifth and final investment is, without a doubt, the most important and the one with the highest possible return: investing in yourself. Money is just a tool. Your ability to earn that money is the engine that drives your entire wealth-building journey. The more powerful your engine, the faster you'll reach your destination. Unlike financial assets that can go up or down, the skills and knowledge you acquire become a permanent part of you. No market crash can take away your expertise. Think about it in concrete terms for 2025. What high-income skills are in demand right now? We're talking about digital marketing, data analysis, coding, AI prompt engineering, sales, and graphic design. You can learn these skills, often for free or for a very low cost, on platforms like Coursera, Udemy, or even YouTube. Earning a new certification in your field could be the leverage you need to ask for a significant raise. Beyond skills, consider starting a side hustle. This is where you turn your knowledge into an additional income stream. Are you great at writing? Start a freelance writing business on Upwork. Do you have a passion for crafting? Open an Etsy shop. Your side hustle income can then be used to supercharge your investments in stocks and real estate, creating a powerful self-reinforcing cycle. A $5,000 raise from a new skill invested annually can grow to hundreds of thousands of dollars over your career. Your skills compound faster than money because they increase your capacity to earn, save, and invest more. Never stop learning because the more you learn, the more you earn. So we have our 5 key ingredients: ETFs for growth, REITs for cash flow, bonds for stability, a small slice of crypto for speculation, and a relentless investment in yourself. Now, how do we combine them? This brings us to the golden rule of investing: diversification. You've heard it 1,000 times. Don't put all your eggs in one basket. This isn't just a cliche, it's the core principle of sophisticated risk management. By spreading your investments across different asset classes that behave differently in various market conditions, you smooth out your returns and protect yourself from catastrophic losses. Let's visualize a hypothetical portfolio. It's not a one-size-fits-all, but a starting point. Imagine a pie chart. A large portion, say 50 to 60%, is in low-cost stock market ETFs, serving as your primary engine for long-term growth. Another 15 to 20% could be in REITs, providing diversification and a steady stream of dividend income. A solid 15 to 20% sits in bonds and a high-yield savings account, acting as your portfolio's anchor and safety net. Then, a tiny speculative slice of 1 to 5% is allocated to cryptocurrency. And underpinning all of this is your ongoing investment in yourself, which constantly increases the amount of money you can pour into this system. Your personal mix will depend on your age and risk tolerance. A 25-year-old can afford to be more aggressive with a higher allocation to stocks. A 60-year-old nearing retirement will want more in bonds to preserve their capital. The key is to build a resilient portfolio that can weather any storm, and to understand that wealthy people never rely on a single source of income. They build multiple streams, from their job, from stock dividends, from real estate rent, and from their own businesses. This is the blueprint. If you've watched all the way to this point, I want to sincerely congratulate you. You haven't just watched a video. You've made a significant investment in your financial literacy, which is the most valuable asset you will ever own. Knowledge is the foundation upon which all wealth is built. Now it's time for action. Thank you for investing your time with us today. If you found this guide valuable, please subscribe and join our community. We'll be doing deep dives into each of these topics in future videos, giving you even more tools for your financial arsenal. Remember, the journey to financial freedom is a marathon, not a sprint. It's built on consistency, patience, and the smart, informed decisions you make every single day. The best time to start investing was yesterday. The second best time is right now. Until next time, keep learning, keep growing, and keep investing in your future.